Have you ever imagined having an account balance of $2 million? Have you also thought about the dreams you can fulfill with that money? It would be amazing to build a strong investment portfolio and grow the account balance to $2 million to become a multimillionaire. Becoming a multimillionaire can help you escape the routine of the 9-to-5 race so you can start focusing on growing your wealth even more. In this video, we will learn about long-term growth strategies that could make you a multimillionaire. Before we begin, please note that this video is for learning purposes. It is not financial advice. Investing has many downside risks. Please perform additional research before investing. Now, let's take a look at some examples of exponential growth using simple investment strategies. Let's start with a simple strategy of saving and investing $2,000 every month. If you invest $2,000 every month and achieve an annual return of 8% each year for 30 years, you would contribute $720,000. With the magic of compounded growth, your account balance will grow to $2,980,719. Now let's take a look at what happens if you are able to save more money to invest $4,000 every month. If you invest $4,000 every month and achieve an annual return of 8% each year for 30 years, you would contribute $1,440,000. With the magic of compounded growth, your account balance will grow to $5,961,438. Let's understand, how does the exponential growth of investment occur over the long term? Let's take a closer look at the massive exponential growth. If you invest $4,000 every month and achieve an annual return of 8% each year for 30 years, and the $4,000 are being contributed at the end of every month, you would have contributed $1,440,000. This is the money you personally contributed. The total growth of the money would be $4,521,438. This is the magical growth created through compounding over 30 years. The final account balance would be $5,961,438, which is significantly more than the amount you contributed. Now let's take a look at a graph of the exponential growth happening over the 30-year time frame. In the first 10 years, the account balance would get to $731,784. In 20 years, the account balance would get to $2,356,082. And in 30 years, the account balance would get to $5,961,438. The growth is relatively slow in the first 10 years. The growth rate starts increasing after the account balance crosses $500,000. After the 10th year, the account grows exponentially due to the effect of compounding. Let's take a look at the process of creating more money through compounding. The big question to understand here is, where did the extra money come from? Let's take a look at the numbers more closely. The total amount invested would be $1,440,000. The compounded growth generated by the investment would be $4,521,438. That brings the final account value to $5,961,438. Looking at the breakdown, 24% of the final balance came from your own contributions, and 76% came from the compounded growth. So the key takeaway is simple. Most of the final balance came from the magic of compounded growth, not just from the monthly contributions. Let's take a look at the way money creates more money as part of the compounding process. At the beginning, you would get started with a small amount of money. This is the foundation of the investment. The money starts to grow with your monthly contributions and the 8% annual growth. Your original money is still there, and it has also created additional money. After a few more years, the growth becomes easier to notice. At this stage, both the original money and the additional earnings are working together in your investments to generate even more growth. Over the long term, the compounding effect becomes much stronger. More money is now working for you, so the growth starts building faster and faster. This is how money creates more money over time, with the power of compounding combined with long-term investing. Before proceeding further, it is important to understand the steps for getting started with a long-term investment strategy. Let's understand how to start compounding growth today. First, it is important to get started today. The best time to invest was many years ago, and the next best time is now. The next step is to set up automatic investing. Create automatic investment rules for every month so your investing stays on track. Then be consistent with the investment. Invest regularly and stay committed for the long term. And finally, let time do the magic to turn steady investing into exponential growth. Let's take a look at some of the typical long-term investment choices for beginners. Please note that these examples are provided for learning purposes. Please perform additional research before investing. The first ETF to review is VOO, the Vanguard S&P 500 ETF. It tracks the S&P 500 and provides exposure to a diversified portfolio that also includes many established U.S. companies. The next ETF is VTI, the Vanguard Total Stock Market ETF. It tracks the total U.S. stock market and provides broad diversification across U.S. companies. VXUS is the Vanguard Total International Stock ETF. It tracks international stocks and provides exposure to companies outside the United States. QQQ is the Invesco QQQ Trust. It tracks the NASDAQ 100 and provides exposure to growth and technology-focused companies. In addition to understanding the long-term growth strategy, it is also important to understand the common mistakes and risks to avoid while investing. Let's take a look at the common mistakes to avoid. First, not starting early can have a huge negative impact. Waiting even a few years can cost you hundreds of thousands of dollars over many years. Next, being inconsistent slows down the growth, since irregular investing breaks the power of compounding. Withdrawing money from the investment account also reduces the growth prospects, since withdrawing stops the money from compounding further. Finally, speculative strategies may sound exciting, but using speculative strategies often leads to unnecessary risks and losses. Managing uncertainties and risks is an important part of investing. The first major risk is lack of recovery. Some indexes and stocks may not come back up to prior peaks and cause significant losses. Next, reduced compounding can slow down growth. Investment losses and inconsistent contributions can reduce compounding over time. Another major risk is market volatility. Markets can drop sharply and unexpectedly. Finally, insufficient research can hurt decisions. Not doing enough research before investing can lead to poor decisions. Thank you for watching this video. I hope this information is helpful in inspiring you to start saving and investing regularly. Please like this video and subscribe to the channel to see more videos related to investing and finance. Please also comment below to let us know about your investing questions and your experience with investing regularly. Thank you again, and I will see you in the next one.